morning to one and all. Welcome to my YouTube channel. This is Narayan Rao Kovur. In this video, we will discuss the details of national income accounting. What is the meaning of national income and measurement of national income in India, and some of the key terminologies related to national income accounting. First, what is the meaning of national income? National income is the total market value of all final goods and services produced in a country during a given period of time, usually one financial year. This is called national income. In other words, so in general, a country's income is calculated by summing up the aggregate value of all the final goods and services produced in a country during a one financial year is known as national income. Right. National income accounts are fundamental aggregate statistics. National income accounts are fundamental aggregate statistics in macroeconomic analysis. And also, national income accounts are useful for emerging economies and transitional economies. Emerging economies are the countries that are grow rapidly and shifting from low income to middle income with industrialization, rising GDP, but not at fully developed economies. Those are called emerging economies. BRICS countries are best example for emerging economies. And also transitional economies. Transitional economies are those economies which are shifting from socialistic economy to capitalistic economy, a command economy to private economy, market economy. That means socialistic economy to capitalistic economy. For example, Poland, Russia, Ukraine, China, etc., etc. Next. So, Nobel Prize winning economist Simon Kuznets and Richard Stone introduced the national income accounting as macroeconomic accounts from the production stage to the stage of final disposal of goods and services. So, in economics, Nobel Prize winning economist, one is Simon Kuznets. He got Nobel Prize in 1971. So main contribution is development of national income accounting. And second one is Richard Stone in 1984. Main contribution is system of national accounts. So Richard Stone also called father of national income accounting. So Nobel Prize winning economist Simon Kuznets and Richard Stone introduced the national income accounting as macroeconomic accounts from production stage to the stage of final disposal of goods and services. Next, measurement of national income in India. Measurement of national income in India. So, measurement of national income in India took place two types. One is national income calculated at central level and national income calculated at state level. Point one is at the central level. At the central level, Central Statistical Organization has the responsibility in the Ministry of Statistics and Program. So CSO calculated national income at central level. CSO established in the year 1951 started calculation of national income from 1954 onwards. At the second one is at the state level. At the state level. At state level, State Directorate of Economics and Statistics has the responsibility to calculate national income in our country. So one is at the national income at the central level by CSO. So national income at the state level by state DES. This is the introduction and background of national income accounting. Next, important terminologies. Important terminologies. One is intermediary goods, another one is final goods. What are the differences between intermediary goods and final goods? So, intermediary goods are the goods which are used either for resale or for further production in the same year. Intermediary goods are those goods which are used either for resale or for further production in the same year. Those goods are called intermediary goods. For example, milk used in dairy shops for resale or milk used to make curd or cheese. Example for intermediary goods. So, here it includes the value of goods and services consumed as inputs in production. The value of goods and services consumed as inputs in production. They are taken into consideration to calculate national income. And excludes are fixed assets. Fixed assets are excluded from the calculation of national income. These are the details of intermediary goods. Next, on the other side, final goods. Final goods are meant for final consumption in the same year. Final goods are those goods which are meant for final consumption in the same year. Those are called final goods. Milk purchased by the household for consumption. Milk brought for drinking. Example for final goods. Next, final goods refer to those goods which are used for consumption. All the groceries by household and are for investment, that is fixed assets by the business firms. So taken into consideration. So in the point of final goods. So these are the differences between intermediary goods and final goods. Next, factor income and transfer income. What are the differences between factor income and transfer income? Factor income is received in return for rendering productive services. Factor income is received in return for rendering productive services. So it is an earned income. It is a earning concept. That is why it is included in the national income. And the summation of the factor incomes gives us factor cost or factor payments. Factor income or factor cost or factor payments are same. Therefore, the summation of the factor incomes gives us factor cost or factor payments. Factor cost is equal to rent plus wages plus interest plus profits. Then you will get factor incomes, factor cost, or factor payments. So on the other side, transfer income. It is received without providing any good or service in return. Transfer income is the received without providing any good or service in return. That is called transfer income. It is an unearned income. Unearned income, not earned income. That is, it is called receipt concept only. That is, it is not included in the calculation of national income. So transfer incomes also known as transfer payments or transfer cost. So transfer income also known as transfer payments or transfer cost. So transfer income is equal to current transfers by the government, gifts, donations, scholarships, unemployment allowance. That is current transfers by the government plus national debt interest plus net current transfers from the rest of the world. We add all these three, then you will get transfer income. These are the differences between so factor income and transfer income. So thank you for watching. Like, share, subscribe and comment.